could you speak next? Sure. Thank you very much, Don. And much of the territory I'm going to go over today, you've already covered, which is great. But what I want to talk about today is that the global financial crisis does not prove that regulation is needed. What it proves is that the unintended consequences of governments and leaders looking to change the way markets operate actually made this global financial crisis as big as it was. And I want to take you back to a day just over a year ago. It was a Sunday. My background is as a financial journalist for Reuters in London. And when I was there as a mergers and acquisitions reporter, my job was to get close to analysts and investment banks. And I got close to some people inside Lehman Brothers in London. And I've left London, obviously now, but some of my colleagues there got close to Lehman Brothers analysts just before Lehman Brothers collapsed. Obviously, we get the good goss, because that's your job as a journalist. And this reporter got to know the Lehman Brothers analyst and could tell that things were going wrong and said, please send me a text message when you know it's really going pear-shaped, if it does. Now, this analyst, on the Friday afternoon, asked his boss, should I fly to New York this weekend for a conference? And the boss said, no worries, everything's fine. The federal bailout out will be all dandy. And so this analyst jumped on a plane and flew to JFK from London. He arrived there and got a text message from his boss saying, we're gone. The Fed has let us go. So he decided, I'll buy a ticket and I'll go back to London. Took his credit card out, went to the machine, the airline office didn't work. It was a company credit card. It had already been cancelled. So he's pretty grumpy as an analyst, and he decides to send a few text messages to his mate at Reuters. I know, you pass the story on to me. And so this analyst is quite a good communicator, can tell the story in a very short amount of space. Sent a text message to my colleague saying, Fed has let us go. That's an interesting moment, which unfortunately we never saw again during the last year. Fed has let us go. And he's feeling worried, he's actually had a few beers at the bar. So he sends another text message. And unfortunately he uses a rude word. It says, we are, letter R, fucked. And then he really gets into it. He says, because he knows that Reuters relies on sales to investment banks and others to make money. And he says, after we are, he says, you are fucked. which is fair enough. And then he really gets into it, because he understands the connections, the interconnections between Lehman Brothers and all the other banks, and knows that when Lehman Brothers collapses, it's going to bring down others with it. So he says, very quickly, the market is fucked. And then he's really getting into the swing of things now. He's on to his third beer, and he says, we are all. And that was a moment in time which, unfortunately, I think, was never repeated. In the following few days, AIG was on the verge of going under after it was damaged by the Lehman Brothers collapse. And then the Fed stepped in and decided to rescue AIG to the tune of almost $1 trillion on its own for AIG. Now, just to step back a bit, this was in the midst of the crisis. In the following week or so, Treasury Secretary Paulson and Ben Bernanke, the Federal Reserve Chairman, went to the Congress literally on their knees. Sometimes not on their knees, actually yelling at them. And we've heard from various reports from those meetings that took place behind closed doors in those last weeks of September, that they said, we must bail out the financial system or it will completely collapse. What had happened over the preceding 20 years was that Federal Reserve chairmen, including Greenspan, Don Brash was very kind to Dr. Greenspan and not mention him, no doubt because he's met him and shook his hand. I haven't met him and shook his hand, so I'll be very grumpy about Mr. Greenspan. His decision, almost immediately after he was elected in 1987, appointed to effectively bail out the stock market in the days after the 1987 crash by cutting interest rates drastically, and then to do that many, many times over the following 22 years, was to instill within Wall Street's investment banks and the global financial system the idea that no matter how big they got, no matter what they did, they were going to be bailed out. That someone was going to fix it. This became known as the Greenspan put. This meant that no matter what they did, someone was going to bail them out. Greenspan was going to do it with lower interest rates. He did it several times. He did it through the 90s, at least 2 occasions. He helped avoid the collapse of long-term capital management by forcing banks to jump in there and buy it out. He did it again in the wake of the 9/11 attacks, when he cut interest rates, as John pointed out, to 1% at an obscenely low rate, which of course, because much of the economy is connected to that low rate through fixed currencies, washed enormous amounts of cash out around the world and helped fuel the property booms all around the world, and of course the boom in private equity, and indirectly the boom in securitized mortgages. What this meant was that banks and market participants believed that they could grow and grow, not just their leverage but their size, and do things that would mean that even if they did collapse, it wouldn't matter, they would be fine. At that moment in time, when that analyst sent those text messages, was the one moment, one day, when the US Federal Reserve and the US Treasury had some sort of moral fortitude. Within a few days, they had lost their backbone and decided to place trillions of dollars of debt, upwards of $7 trillion, depending on who you believe, of debt on the taxpayers of America. Of course, this didn't just happen in America, it happened in Britain to a huge extent as well, because the global financial system believed they had the Greenspan put, and they also had the Bernanke helicopter. Has everyone heard of Bernanke's helicopter? If he gave a speech in 2002, which was widely read at the time, and certainly reread when he was appointed as Federal Reserve Chairman, in which he said, because he was a scholar of the Depression, and he believed the Depression was caused by the Federal Reserve tightening monetary policy too quickly, that the way to solve depression and inflation was to fly over the market with a helicopter, open the door, and push money out to the door. Now, helicopter blades are fantastic because they just spread it wonderfully. The money floats down everywhere and we're all fine. So helicopter beam and the Greenspan put encouraged investment banks and global financial markets to go for gold because they believed they would be bailed out. They got the shock of their lives when Lehman Brothers was allowed to collapse. And so the authorities decided to continue to bail out AIG. They forced Merrill Lynch into the hands of the competitors. Bear Stearns was allowed to go, but essentially was cleaned up with money. And since then, again and again, the US government and the Treasury have bailed out financial institutions. There have been many cases in the past where governments have decided to intervene, for example in the wake of Enron, to try and force markets in the direction they wanted. Of course, regulatory arbitrage is one of the best ways to make money. And unfortunately, when you put these regulations in place and you try to push things in the way you want them, you're extremely bright, well-paid people who spend all their time not actually producing anything, but trying to extract profit from regulatory arbitrage. The best thing I think that could have happened in the last 20 years was for Greenspan to not try and bail out the market. For Bernanke to not tell everyone he would bail them out with his helicopter load of cash. Those banks would not have grown so large, those directors would not have taken those risks, those CEOs would know that they would lose their jobs and lose their bonuses if they didn't. Instead, and I'll leave it on this note, when the US Treasury decided to bail out the banking system and to give essentially a government guarantee to the investment banks as well as the main commercial banks, Goldman Sachs, and many people argue, because it was closest to the government, got the best deal for itself. Was able to get essentially a government guarantee to continue as a hedge fund, and that's still in place. In March this year, it announced an enormous profit, announced bonuses of $9 billion for its investment bankers, and then said it would pay another $10 billion in bonuses to its investment bankers over the next year, because it was using a government guarantee to essentially print money for individuals. I say that the global financial crisis was proof that government intervention and an attempt to regulate the market aggressively created huge unintended consequences that mean we are in the mess we are in today. Thank you.